Is the market turning its back on the Federal Reserve? Is it telling the Federal Reserve that if they cut rates now or soon, that they'll be cutting rates into a higher inflation environment? We'll see.
You are going to get left behind in this economy because your finances are not well positioned. My name is Khayri. I'm here to expose the right way for retail traders and investors like you and me to approach financial markets. So before you start day trading or buying financial products, you need to understand certain principles to ensure you're well positioned to build wealth over the long term. This is how a really good trader is formed, by trading with a purpose and a more significant objective. So, do you want to learn how to construct the best wealth building portfolio? Then I suggest you click the link in the description to purchase my book, One Small Tweak. This book will expose precisely what products go into our foundational portfolio and then how to tweak these products for superior performance. And lastly, for your life insurance needs, I am currently offering a free 15-minute call. So, whether you're someone who needs consultation on the best policy type, I specialize in term policies and policies that are designed to build wealth.
Welcome back to another episode of Well Positioned. This is our market check-in segment. There's two things that are telling us the market is screaming inflation, and there's two asset classes that are actually proving it today. We have some major price action, some unprecedented price action for the entire year, in fact, since January. So we want to take a look at those couple things and get an idea of how do we move forward? How do we position ourselves in an environment that is screaming higher inflation? Is the market turning its back on the Federal Reserve? Is it telling the Federal Reserve that if they cut rates now or soon, that they'll be cutting rates into a higher inflation environment? We'll see. Some key economic data that came out over the last few trading days that kind of supports what I'm saying here in terms of inflation, or that the market is screaming inflation. The first key data point is corporate profits. Corporate profits came in at 3.9% quarter over quarter, which was way higher than what was forecasted at 3.3%. So we're showing that corporate America is on fire. Their bottom line numbers are performing very well. They have a lot of brand power, a lot of pricing power. They're able to attract a lot of talent, and it's showing up in the numbers. So when we think about positioning ourselves in financial markets and in stock markets and things like that, we have to remember that we are investing in essentially corporate America and not the US economy. See, the funny thing is, purchasing government bonds is actually investing in the US economy. But purchasing stocks from corporations is actually investing in corporate America. So we want to make sure that we understand what it is exactly we're doing and where we're putting money when we're doing such. Another key data point that came out was actually on Friday, March 29th. We see that personal spending month over month had an increase of 0.8%, which is a huge jump from the 0.2% from the previous month, which is an even bigger jump from what was forecasted of 0.3%. So they forecasted 0.3% and it came out 0.8%, which is more than double what was forecasted. That is of concern because that is speaking to what the market is saying about, hey, inflation is still here to stay. This market is screaming inflation, and I will continue to reiterate that as we move through these segments. And it's important that we show the data to kind of back that claim up, because once we identify that the market agrees that we are in an inflationary environment, I mean, we see that just when we go to the grocery store, we go to purchase a house or a car or anything. The price tag on those items for the same items that we've been purchasing all these years are much higher in the last couple of years and couple of months than they have been. And we need to identify why that is so that we can then know how to position ourselves, position our wealth to make sure that we are, that our wealth is also inflating in the same context. Another key data point looking right above it is the personal income month over month. So we're seeing that the personal income month over month came in right at consensus. They predicted a 0.3% rise in personal income. It came in at 0.3. The previous month was 1%. So they predicted a slower rate of change in personal income for this month versus the previous month. Now, that's very important because we're seeing that we're not making more money, or maybe ever so slightly, but we are spending more money. So with the personal income versus the personal spending, we see that we're spending more money and making about the same amount. And that probably speaks to a lot of people, myself included. I feel that, my income hasn't quite jumped, in the last few quarters, but I feel like I'm spending a lot more money, and I'm sure you probably agree too. So before we move to the charts, I mean, those few key data points that I just showed there are very important. And there's other ones that kind of support the inflationary claim that not I am making. It's not me that's making the claim. The market is making the claim, and I am in full agreement with the market that it is screaming inflation. And like I said, I will continue to reiterate that. So one of the things we're going to look at, actually, two things we're going to look at to um, kind of back the claims up we're seeing in the data, but now we're going to show how it is reflected in certain assets. And the main asset we're going to look at is what the bonds are actually doing today. What the bonds are doing today is very important. The price action that we're going to see, the rate of change in bond prices and higher interest rates is something that we have to pay attention to because we're seeing a unprecedented move in the bond market for the start of the year. And we're also going to look at oil prices. Oil is also making a big move to the upside today. And both of those things, when we see bond prices fall drastically and oil prices rise drastically, those are screaming inflation. This market is trying to tell us that inflation is not only is it here, it's here to stay for longer than what we've been told. That brings me to one point that I want to make before we actually look at these assets in real time. You know, a lot of folks diversify their assets and their wealth into bonds because they believe it is a safe haven. And what we're seeing here today is that safe haven is not so safe. When you have bonds that are drastically decreasing in price, like I'm going to show you here in the charts. And in fact, let's pull up the charts as we are breaking some of this information down. We're looking at bond prices today. And this is the /ZB. This is the bond futures index. And we're seeing that bonds are having their biggest decline, their biggest daily decline all year. So we're seeing bonds are down 1.6%. And no other move at all this year has been that large in the fall of bond prices. So when bond prices fall, what does that mean? That makes purchasing a home more expensive due to higher mortgage costs. That makes purchasing a car more expensive. That makes paying off credit card debt more expensive. That makes the price of pretty much doing anything on your balance sheet more expensive if you hold any debt or if you're trying to purchase things with debt. So all of those things, and us as consumers who typically hold the most debt, that makes life a lot harder trying to manage through that. So, we have to ask ourselves what assets and where do we need to be positioned when we're seeing a market showing us and screaming to us that inflation is here. So moving forward, I just wanted to reiterate that. So, that's one of the reasons why I wrote the book. One small tweak is because we speak about a better bond. Because if you have your assets and your wealth stuck in these long-term tradable bonds, like, you know, bond futures are simply just reflecting what it is I'm talking about. But we have our money in target date funds. We have it in 60/40 bond splits and, maybe some money in the S&P, the SPY, and some money in the TLT, which is another bond ETF. And we'll look at the TLT real quick. We see that TLT is down 2.18%. I mean, for a safe haven asset that's down over 2% in one day, how safe is that really? I think we can do way better. Another asset we're going to look at that is screaming inflation is oil. The price of oil is up 1.3, almost 1.4% in one day. Now, this is not the biggest move we've seen in oil in a while, but it is certainly up there in terms of percentage increase. This is a huge move to the upside and actually had a huge move on Friday or on
on Thursday, the last trading day. So we're just going into the start of the quarter. This is April 1st, start of Q2 of 2024, and we're seeing, some tall tale signs of inflation, and the market is letting you know, hey, this is how we're feeling. We're not looking to run to bonds for safety. We're not looking to run to any of these typical safe haven assets that we talked about. Now they are running into gold a little bit, and we see that here. Gold is up a little bit over 1.1%. And gold, this is a counterintuitive move because typically we've seen that gold typically was an asset that would decline when interest rates would increase, and the interest rates in gold kind of worked in inverse. Gold typically increased during a deflationary environment, at least in terms of how the market traded it. But we're seeing that kind of correlation break down, and actually we're seeing gold rising with long-term interest rates. And that's something we got to pay attention to because, if that continues, there's really nothing to stop gold from going higher and higher and higher. Because if inflation keeps going higher and higher, it's, very probable that gold will continue along with it. We'll leave it there for now. I don't want to get too much into the weeds, but I definitely wanted to highlight a couple of things that for us to look at and pay attention to. Seeing stocks, are pulling back a little bit while bonds are down drastically. Tech is pulling back a little bit, but it's not, too much of a pullback for concern with, in regards to stocks. So it's not even enough to make a case about right now. But if we do start to see stocks declining and bonds declining at the same time, the question then becomes, where is the safety trade? Where do we go for safety? Are we running to gold? Are we running to oil? Are we running to the commodities market to look for safety? That's a question that is yet to be on the table, but we'll keep an eye on it. Thank you for checking in with me in this market check-in. We'll be back again.